UiPath just reported their latest quarterly figures, a beat across the board for a quarter and actually beat the consensus figures for guidance as well. And yet, the stock is down 7% at the time of making this video. We're back under $14. Now, year on year, this stock is down 40%, and year to date, the stock is down, well, also closer to 40%. In the last 3 months, the stock did see a revival, up 17%. Well, now it's going to be up closer to 15% or so. But yeah, I mean, there is some things to like, I would say, in the report, but overall, I just don't see the appeal right now. This is a company with a market cap of $8.22 billion and a forward P of 37.5 times. If you look at what the analysts are expecting this company to do, I mean, we've seen worse, definitely, but we've also seen much better than this, right? Now, you could say, okay, market cap of $8 billion could be an acquisition target, and I would agree. Right now, if you look at the average analyst price target, that will sit around 5% higher than the price we're at right now. If we look at some pricing metrics here, on all of those metrics, we are lower than the, let's say, 2 to 3 year mean. But in UiPath's case, that really doesn't mean that much. Remember, UiPath also did a whole switcheroo with the CEOs back to the roots. So it really remains to be seen if they can execute their strategy. We are now in the age of AI automation, so they should be gaining momentum. The question here is, why aren't we seeing it? Or why aren't we seeing it just yet? Let's discuss that in this video. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. We're also going to cover Lululemon, so stay tuned for that. And if you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Let's start with a major overview here. Revenue growing 9% year on year to $355 million. ARR growing 17% year over year to $1.6 billion, but the growth rates are decelerating. Then non-GAAP operating income was $50 million and non-GAAP operating margin was 14%. Now, all in all, if we zoom out a little bit, we can see what the analysts are expecting this company to do with regards to free cash flow. So free cash flow in the last 12 months is, well, around $326 million. It's actually a bit less than that because this still needs to get updated. I think it's around $318 million or so. It's expected to grow 9%, 8.6% in the next 2 fiscal years. Then if we look at the different segments here of revenue, so we've got licenses, which is the red bar, subscription services, the blue one, and then professional services is basically this color right here. Now, quarter over quarter, you can see growth. The problem here, well, part of the problem is that year over year, you can see that license revenue is actually down. Subscription is up, which is great. And then if we look at the professional services, that's up a tiny bit. But as you will see in just a bit, it is costing them to grow certain revenues and costing them quite a lot. Now looking at something that's a bit more positive, let's say, and that's the, well, ARR here, annualized renewal run rate, which is quite good, although revenue year-over-year growth has been slowing down. What has also come down quite a lot is dollar-based net retention rate. We're now at 113%, which is still good, but it keeps going down quarter after quarter. And so if we dive a little bit deeper, we can see the following thing. Like I said, license revenue is down 7% year over year, but subscription services up 23% and professional services up 2.2%. So total revenue is up 8.8%. Now the cost of growing those revenues is the following. So licenses is down. The cost of growing revenue is down 15.86%. But then again, license revenue is down 7%. But subscription services, remember, subscription services revenue increased 23%. But for that to happen, cost of that has increased 51.79%. That's not great. Professional services and others is down 3%, but that segment did grow a little bit, so okay, that's fine. So overall, total cost of revenue is up 27.73%, while revenue as a whole is up only 8.8%. So yeah, not great. Gross profit is up 5.39%. Then switching to total operating expenses, as you can see, it's basically flat-ish year over year. We've seen a small decrease by 2.14% for sales and marketing, an increase in R&D 14.74%, and then another big decrease 10.59% for G&A. Switching to the next part here is net loss. Net loss did improve by 33.7% year on year. Still a loss though. And then the last thing here, shares outstanding has been reduced by 2.82%. Now as for guidance, they expect revenue to come between $422 to $427 million, ARR $1.669 billion to $1.674 billion, and non-GAAP operating income of around $100 million. CEO said the following: our customers' response to the agentic automation vision and roadmap that we announced at Forward has been energizing and reinforces our leading position in the AI-powered automation market. We have conviction that UiPath provides a differentiated approach to agentic automation that will expand our market opportunity by enabling customers to automate more complex and variable workflows to deliver enterprise-wide AI transformation. I mean, they are working with most, if not all, of the big tech companies and AI companies. And so, doing a quick reverse DCF here, plugging in all the numbers, we can see that to justify the price right now after hours, free cash flow has to grow by 5.8% for the next 10 years. Now, we've seen that it is expecting to grow free cash flow a bit faster than that in the coming fiscal years. So, yeah, maybe there is some value to be found right now at these prices under $14. We're also back under the 200-day moving average, so let's see if it can stay above the 20 and the 50-day one. It did have some solid momentum since the bottom right here at the start of August, which you can see is basically a double bottom from the last time it went there, back at late October 2022. There was some solid momentum here. We can see that with RSI as well, but right now with this quarter, I mean, again, it's a beat across the board, so it could very well be that tomorrow, if it's a good day in the market, it gets back up. Could very well be. But does it get you excited to buy this stock at these prices with the current growth rate? Let's be honest here. Me personally, no. I mean, this company could be doing very, very well, but that's about it, right? That's about it. It's nothing special. You could be buying it in the hopes that another big company comes in and buys it at a premium. And that's about it, right? So unless, I don't know, in the coming quarters, we suddenly see a reacceleration in growth, big clients, backlog is increasing, net dollar-based retention is going up, etc., then fine. But right now, it's really a show me what you've got before we get excited type of company, right? At least that's what I'm thinking. So if I'm wrong, do let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.